Hi, my name is John Kinzer, and I'm your instructor this semester for Accounting Principles 1, an introduction to financial accounting. I wanted to introduce this course with 2 lessons that will focus on a couple of topics that I think if you pay close attention to early will help you find greater success in this course. You know, a lot of people come to accounting and they think, oh man, this is just so confusing and so hard and I don't understand the math, I'm bad at math. And I think you'll find that in fact accounting is quite logical and follows a simple formula that we're going to discuss in today's lesson, the accounting equation. This lesson, combined with the journalizing lesson that will follow in lesson 2, I really want you to focus on these. I want you to pay attention to these concepts, absorb them, make sure you understand them, and if you do, I guarantee you're going to find this class to be much simpler and you're going to have a much better time. So, welcome to the course. Always feel free to email me with your questions. Let's begin.
Today we're going to talk about the accounting equation. And quite simply, the accounting equation states that assets equal liabilities plus owner's equity. And what do those 3 terms mean? Well, an asset is any item of value that the company uses to produce revenue. And those items can be tangible or intangible. We'll address that more later in the course. Liabilities and owner's equity describe the 2 account categories that we use to fund those assets. Liabilities include debts owed to creditors. You know them as loans, leases, credit accounts, like a credit card, for example. Owner's equity is the owner's contribution to that asset. It can be cash. They can contribute assets themselves to the company. And assets minus the liabilities equals the owner's equity. Now, I want to give you an analogy of something that we're all familiar with to describe how this equation works. And the key takeaway here in this lesson, and this is what I really want you to focus on, is that this equation must always be in balance. In fact, everything we're going to do in this class is working to bring this equation into balance as we transact business. So let's get back to our equation. Assets equals liabilities plus owner's equity. And let's take one particular asset that we are all familiar with, your home. Let's say that theoretically my house is worth $200,000. And I acquired that house by securing a mortgage of $160,000 and applied cash equity of $40,000. Now, let's say that the Phoenix market just takes off like a rocket and the value of my house increases by $50,000. Now, bringing the total, to $250,000. Now, paying my mortgage has no impact on the value of the house. That's market-based. So that would stay the same. But that would affect my equity. You noticed I added $50,000 to the asset side of the equation, which would require me to add $50,000 to the liabilities and owner's equity side of the equation. So I add $50,000 to my equity, bringing my total equity to $90,000. $90,000 plus $160,000 equals $250,000. The account's in balance. Now, oftentimes when working in accounting, you may be recording transactions on just one side of this equation, on the asset side or the liabilities and owner's equity side. And one way we can demonstrate that is paying the mortgage. So let's say that at the end of the year, I have amortized my mortgage down. I've paid down $5,000 of principal, bringing my total balance to $155,000. Now, paying my mortgage doesn't impact my home's value, so that would stay the same at $255,000. But here I would add $5,000 to equity because I gained that equity by paying the mortgage, bringing my total equity balance to $95,000. $95,000 plus $155,000 equals $250,000. I subtracted from liabilities. I added to owner's equity. It cancels out on just that side of the equation. Balance is beautiful. That's my quote. Feel free to use it. Now, you may be thinking to yourself, well, that's all well and good. I know how a house works, but how does this apply to a company? Well, I'm going to give you a more complicated analogy, and that is the company of you. Corporations, companies, are very much like persons. In fact, the Supreme Court treats corporations as persons when applying their constitutional rights. We can debate the merits of that as good or bad. I don't know. I'll leave that to the philosophy folks. But I think it is a good analogy to demonstrate how this course is going to go for you moving forward. So let's go back to our equation. Assets equals liabilities plus owner's equity. Now, as a person, you're going to own a collection of assets. Most of you probably have a car. You may or may not have a house. And you have miscellaneous stuff. You have clothes, you have furniture, you have artwork, that hand-carved baby Groot doll you picked up on eBay last week. Whatever you're into, I don't judge. And you have that most valuable asset, that squishy gray stuff between your ears, your brain. Now, let's just say for the purpose of this equation that the car is worth $5,000. The house is worth $100,000. That miscellaneous stuff of yours is worth $2,000. And your gray matter, let's come back to that one. Now, let's go back to the car. Let's say that you purchased that car with liabilities of $3,000, the car loan, and $2,000 in cash. 5,000 equals 5,000. The equation's in balance. Now, let's say you acquired that house with a mortgage of $95,000 and home equity or cash down payment of $5,000. 100,000 equals 100,000. The house account is in balance. Let's say that you charged up $1,000 on your credit card to pay for all that miscellaneous stuff, and you used $1,000 in cash. $2,000, $2,000. The miscellaneous stuff is in balance. Now, I assume that most of you have student loans. And I would say that that is the liability account that is associated with your brain. So let's just say for this example, it's worth $15,000. Now, what's great about the brain is in conjunction with all these other assets, it is used to produce revenue. After you get your degree, you're going to go out there and you're going to get yourself some great fancy job. And let's just say that you are going to earn $25,000 a year. Not exactly breaking the bank, but you got to start somewhere. Now, that brain's going to need some expenses. You need to eat. You need to entertain it. You need occasional bottle of wine, whatever. So let's put some expenses in there for $15,000, giving you $10,000 in scratch left over the course of the year. Now, what's another word for scratch? Cash. And cash is an asset because, one, it has value, and it can be used to produce revenue. So the car balances $5,000, $5,000. The house balances $100,000, $100,000. Your stuff balances $2,000, $2,000. And the revenue that you produced with that big old brain of yours balances out with the cash. So what does that say about the value of our brain? It says that we have a $15,000 liability left on this side of the equation. So our brain must be worth exactly what we invested in it, $15,000. So let's total it all up. You add up all those assets, $132,000. Add up all those liabilities, $114,000. Add up the equity, you are worth a whopping $18,000. Not exactly ready to retire on a beach somewhere, but you are on your way. So to further demonstrate that, total assets, $132,000. Total liabilities and net worth, $132,000. Balance is beautiful. Now, over the next couple days, I really want you to focus on this equation and what it means. Understand how these account categories interchange with each other. And if you do that, you're going to find this class is going to go much smoother. And that's about it. So I want to welcome you to the class and stay tuned for lesson 2.